Hey, Bulls and Bears, it's JJ here. You're watching Bull, Boom, Bear, Bust. Back with another dose of economic reality. Let's go ahead and get right into the news where we talk about the economy, the financial situation, your money, my money, our money. Now, sometimes people that know me, they ask me, how can you just talk about financial economics all the time, every day? Well, basically, finance is now survival. Some people say, well, don't be so obsessed with money. Money's, the root of all evil. It's not the be all end all. And I agree. But the way that things have been constructed, you're going to be pretty miserable without enough money. You're going to be homeless, basically. And I think someone put down in comments on this channel, humans are the only creatures, I was going to say people, but we're talking about the entire uh, world of living things. People are the only living things that have to pay to live somewhere. Now, you could say other living things pay in the form of labor. For example, birds have to go fly around and get things to build the nest out of. And we're getting off into some weird stuff here, but humans are the only ones that have to continually pay just to not be homeless. Even if you have your home paid off, you never own it. And there's other expenses that you have to pay. Otherwise, bye bye home, you're going to be homeless. And I was actually just at the grocery store earlier today, and the cost of eggs. But somebody was behind me in line, and I was going to let them go ahead of me. They had like just two items, and I had like a cart full. And they said, "No, thanks. I'm not in a hurry because I don't want to go home because there's a crying kid there, which is the guy's nephew." So we had enough time to chat a little bit more. Basically, long story short, his sister just moved out from Wisconsin because they lost their home. They couldn't pay their rent. So this guy again at the grocery store was telling me that he just got a phone call and found out that his sister was on her way from Wisconsin because they just found out that they got kicked out of their home on such short notice. Now, of course, I didn't get the full background. I don't know if there was um, an eviction moratorium up there in that city in Wisconsin. I didn't get all that, but this is just a situation where you wonder why rents are dropping now and vacancies are going up. This is the type of thing that's happening. More people are moving in with each other, family members relying on other family members, and maybe even friends relying on friends because the cost of living is so outrageous. Rents, home prices, the cost of living in general has gotten to levels that most people can't afford without continually going deeper in debt. So if you're someone now that's not going deeper in debt every month, if you're actually saving money and so you're out of debt and saving money both, then you're amongst a very small percentage of the population. And that's what we try to focus on here in this channel. Let's all try to get to that point where one, we don't have debt, and two, we're saving money each month instead of going deeper in debt. Now, I've been in both situations in my life. I've been in debt and getting deeper in debt each month. All right, without further ado, let's go ahead and get right into the news here. All right, now let's talk about this because this is just so backwards. Wall Street drops more than 1% with jobs data feeding fears of more tightening. Now, remember, this big sell off in the markets was because of good news, which was because the jobs numbers came in pretty good, better than expected. Now, if you look into it like we always do here, and like we did in our previous video, was it one or two videos ago? You know that the good news that was put out there is really not good news. Remember, it was jobs that were added. Most of these jobs were second jobs and or part-time jobs. So people are so stretched thin financially that they have to go out and get a second job. They're using those jobs to roll into the jobs number saying, hey, look at all these new jobs that were added. Isn't this great? In the meantime, the big reason why so many jobs are being added is because more people taking on second jobs, jobs, the gig economy, part-time jobs, in addition to a full-time job in many cases. But nonetheless, most of the people really didn't look into it knowing it's really bad news. But what was put out there as good news is actually bad news because that means the Fed's going to look at that and they're going to be less likely to lower interest rates, or as we call it, they're going to be less likely to pivot. And what do markets need to keep going up? Well, they need rock bottom interest rates. They need the ability to borrow money to invest. And that way they only need maybe 1% in gains to cover the cost of borrowing the money. Do you see how this works? It's all on leverage. If this were about people investing money that they actually had, then interest rates wouldn't matter. But it's not about that. It's about big multinational companies, hedge funds, institutions, corporations buying up stocks. And why do I say that? Because we have to remember that one of the big things is that 90% of all stocks are owned by the top 10%. The top 10%. We also talked about that in our previous video. So that's how wacky things are. Good news is bad news for the markets. And if you're making money in these markets, more power to you. I wish you make a lot of money. But most people have about $4,000 in their investment accounts, and that's according to Robinhood. That's the average balance in those investment accounts. What we call retail traders, or just everyday people trading the markets. Fed officials emphasize inflation remains too high and the Fed has more work to do. So anyone thinking about buying what they think is the dip or what looks like the dip in the market, you might want to think again, the way the markets operate, like we just talked about, it's based on easy money. And that's why we're seeing this downtrend in the stock market. We see the major indexes all down from their all-time highs, anywhere from 15 to 25, even 30%. I believe the NASDAQ down from the all-time high peak. And with no signs of easy money re-emerging anytime soon, what makes you think that this is the dip? What makes you think this is the bottom? Don't assume the interest on your savings account is keeping up with the Fed rate hikes. Here's why. Banks don't need your money, so you're still lucky to clear about 1.5% return on the money that you have in savings. And even though the Fed's raising rates, the banks don't need your money. It's to the point now where the banks create their own money. Remember, they can loan out money that they don't even have. So they really don't need your money. That explains why these returns on CDs, the return on your savings account is very, very low. You're going to get very little yield out of keeping your money in the bank. And people say, why don't they give people more money for their savings? Well, they don't need to. They don't have to because, again, they can loan out money that they don't have. We've talked about that a million times here. If they weren't allowed to do that, then yes, they would have to entice people to deposit money with them with a much higher rate of return on your deposit. Who knows what it would have to be, but it would be a lot higher than it is now at a fraction of a percent or 1% if you're lucky. 5, 10, maybe even 15% if banks actually had to have the money that they loaned out. We know that they don't have to have the money. Banks are loaning out leveraged loans and just have a fraction of the money actually in the bank compared to the amount of money that's loaned out by these banks. Otherwise, you would have never needed any bailouts. The banking system would have never needed a bailout. If they had the funds available to cover the loans that they loan out, it doesn't matter if everybody defaults on their loan because they still have the money in the bank to cover it. Of course, they don't have that. That's why we even have heard of bailouts. Now, people looking at the current situation, a lot of people say that this is going to be a bail-in because when you put your money in the bank, when you deposit it at a financial institution, you are basically loaning the bank your money, and you are an unsecured creditor to the bank. So just the opposite of you taking out a loan, now you're the creditor and the bank is the borrower, but the way it's written, it's no longer your money, it's the bank's money. And that, folks, is how they're allowed to go ahead and loan out so many loans with very little in actual deposits. Next, let's jump over to the entertainment world. Why do we want to jump over and dip our toes into entertainment news? Well, entertainment's a big thing that people spend their money on, especially here in the States. The box office hit $26 billion in 2022. This is people actually going to the movies, not at home, but at the movies. And it grew 27% versus 2021. Here's the thing. If you look at the fine print, the box office and the movie theaters are not out of the woods yet. People are still massively cutting back on their movie going. Let's take a look. And we have to dive into this article here a little bit deeper to find out what's really going on. The worldwide figure is now 35% below pre-pandemic average. So yes, more people are going back to the movies compared to last year, looking at the year-over-year number. But overall, the box office is still way down. And another reason I like talking about this is because this is one of the things that people point at to tell me how good that the economy is actually doing. And when I try to say the economy is not that good, it's just people taking on debt that made the economy look good over the past many years. People say, no, JJ, you're wrong. Look at the amusement park. There's a lot of people there. Look at the movies. Look at all these people with things in their shopping cart. Yeah, and it's mostly on debt. If you take away the credit cards, you take away the availability of credit, aka debt from the banks and the credit card companies, a lot of the stores and streets would be mostly empty. I know that sounds extreme or crazy, but yeah, that's what it would be. It would be mostly empty because people are living off of debt. Most people living paycheck to paycheck. All right, so enough of the negativity. It's reality, but it is, it's not positive news to talk about this, but it is reality. So, what can we do to benefit from this? Well, what I'm doing is I'm cutting costs, trying to save up, preparing for what's coming down the road. It's going to be inflation in a lot of different areas, but also deflation in other areas. If you have cash, you're going to be very well to do here in the next few years, able to either one, buy real estate or invest more in real estate. But energy costs, there's a war on energy right now. Those are going to keep going up. The cost of food, I don't see the cost of food coming down. Maybe in a couple different areas, a couple different things. But food is going to be another big drag on many household budgets. Now, some of you may say, why should we go to the movies, JJ? I'm just going to watch streaming at home and save a lot of money. Well, you're missing out on this. If you go to the movies, you may get a popcorn server that can do this. All right, everybody. Keep stacking. Hope everybody's well. And I want to thank each and every one of you watching right now for coming here to watch my news, financial, economic analysis, and commentary. And please subscribe if you haven't already so we can ride out this economic storm together, because things are going to get very challenging going down the road. But I think if we pay attention and we know what's coming, it's going to really be very useful to us here. And as usual, keep stacking. Bye for now, everybody. Big love and peace.